S&P 500 earnings show warning signs across asset classes. The S&P 500 continues to climb in 2025, but beneath the surface, several warning signs are emerging that investors cannot ignore. While earnings forecasts have inched higher, valuations and macroeconomic risks suggest that the market is entering a fragile phase. Rising earnings estimates. Forward four-quarter earnings estimates for the S&P 500 have recently improved, moving to around $284.21. This slight upward revision reflects optimism that corporate profits will stabilize or grow modestly in the coming quarters. Investors typically welcome such revisions, as they indicate resilience in the U.S. corporate sector despite economic headwinds. Valuations are stretched. However, valuations paint a different picture. The S&P 500 is currently trading at a price-to-earnings (PE) ratio of 23.4, with an earnings yield of just 4.26%. These levels suggest that stocks are priced aggressively compared to historical averages. In simple terms, investors are paying a premium for future growth, which raises vulnerability if growth expectations are not met. Broader market concerns. Market strategists highlight that long-term technical indicators, including century-long trend channels, show the current bull run to be overstretched. Such historical comparisons hint that the present rally may be more fragile than it appears. Rising asset prices across equities, bonds, and other classes raise concerns about how sustainable the rally will be if economic conditions shift. The role of interest rates. Much now depends on the Federal Reserve. If the Fed proceeds with interest rate cuts, both equities and bonds could benefit in the short run. Lower rates typically ease financial conditions, boost corporate borrowing, and encourage investment. However, the risk lies in the broader economy. Slowing growth, sticky inflation, or unexpected shocks could undermine earnings despite easier monetary policy. Key takeaways for investors. Earnings forecasts are improving, but not by much. Valuations remain elevated, making stocks sensitive to any negative surprises. The long-term technical picture suggests caution. Monetary policy will be a major driver, but it cannot offset all economic risks. In conclusion, while the S&P 500 continues to rise, the market's foundation is not as solid as headline numbers suggest. Investors should remain alert, diversify across asset classes, and prepare for volatility in the months ahead.